In this video, we'll show you a strategy for trading news events on the Forex economic calendar that actually works. Hi, it's Arnie here from Forex Source, and before you begin, don't forget to subscribe and follow us below so that you'll always be notified every time that we release a new video. Now, you are probably aware of how much the markets can move when breaking news hits the wires. If we just quickly want to illustrate this, the potential, you only need to remember what happened in 2016 after the UK voted for Brexit. Now, in reaction to that unexpected news, the price of the pound fell over 10%. And that was within the first 24 hours, which is basically the biggest one-day collapse in history. Now, in fact, almost every predictable price move that we see in the markets is driven by some kind of breaking news one way or the other. The problem for most retail traders, however, is that it can seem rather volatile and confusing when it comes down to actually trading these events and making profit from them. But don't worry, because we're going to show you a very simple strategy for trading news events that is safe, it's reliable, and it's also consistent. Now, to have any chance of trading news successfully, you first need to understand two very important principles. The first important principle is that the markets move based on market expectations. Now, this means that the distance prices move is directly correlated with how expected the breaking news was or not. So in simple terms, if everybody already expects something to happen, the price won't necessarily move very much. And if no one expects something to happen, then the price will obviously move more and oftentimes move a lot. Now, the second principle you need to understand is that you must always be tuned into the market at all times. Now, this means that you will need to understand what everybody is expecting and also be able to quickly recognize when something unexpected has happened that nobody was expecting. Now, this is vital for obvious reasons. If you're not properly tuned in, then it's likely that you will misinterpret news and possibly trade it in the opposite direction. Now, if you've ever tried to trade news off of an economic calendar without being fully tuned into the expectations, you have no doubt experienced just how frustrating and also how confusing all of this can be. Now, you can get tuned into the market expectations by reading the vast array of analysis that is released regularly by investment banks, by brokers, and also by other trading institutions. Okay, so now that you know these principles, it's time to get into the strategies for actually making money from economic news releases. Now, the first strategy we're going to show you is known as trading into news events or risk events. Now, a risk event is anything that has the potential to cause traders to react in the markets. An economic data release is a risk event. A central bank member that is doing a speech is a risk event. A political election or a vote is also seen as a risk event. So if it might move the financial markets, it qualifies as a potential risk event. Now, a risk event is also scheduled normally ahead of time, which means everybody knows about it before it happens. Now, trading into events is a valid tactic. It relies on the market forming a clear expectation ahead of the actual event. Now, we can illustrate this with the example of, let's say, an upcoming hypothetical economic data point. Let's call it UK CPI. Now, each Friday, the following week's data releases are normally scheduled into the various economic calendars. Now, this usually includes the release of the market expectations, and financial research firms poll different types of traders and analysts, and the results of these polls form the basis for the market's expectation for that specific event. Now, if we have, let's say, UK CPI being released, we will also know that it came out at 2% the last month, and we also know that traders are currently expecting that to print at 1.8%, let's say this month, which is basically worse than the previous. Now, this gives the risk event a negative bias, and in theory, this means a weaker pound. But first, we need to understand the overall sentiment surrounding the pound at that time. Does the market expect the UK central bank to cut rates soon? Is the UK economy overall looking strong and robust, or is it weak? To be a clear trading opportunity, the expected number must line up with the prevailing sentiment. In other words, traders will only sell pound into that negative CPI release if the prevailing sentiment is already negative and unlikely to change too much. Now, if this is the case, we can reasonably expect the pound to gradually fall in price leading up to that UK CPI release or risk event. When the event is released, it is likely that there will be a muted reaction. Now, traders will already have made their profits and will start to take profits as the event comes out. If the sentiment is positive, then there is no opportunity to trade into a negative risk event and vice versa. It's only when everything lines up that the opportunity really arises. If there's no opportunity to trade into a risk event, you might still be able to trade out of the risk event instead. Trading out of a risk event requires the correct circumstances too. The expectations are compared to the prevailing sentiment of the market in the same manner. Now, instead of looking for them to match, they actually need to be the opposite. We will continue using the hypothetical example of a UK CPI release. If the market expects it to be worse than previous, we need the prevailing sentiment on the pound to be extremely positive. This means that overall the market expects the UK central bank to hike rates or to remain hawkish. Now, in this scenario, the best trading opportunity is if the CPI figure comes out much better than the markets were expecting. For example, it comes out with a reading of 2.1% rather than the expected 1.8%. If this happens, it is highly likely that the market will immediately price out the negative expectations of that UK CPI. Crucially, the move will be more prolonged because it lines up with that prevailing positive sentiment on the pound. Now, rarely the outcome of the risk event itself will change the prevailing sentiment of that currency. Now, when this happens, it is also a great trading opportunity. The risk event is negative and the prevailing sentiment is suddenly also changed as negative. A good example of this was during the Brexit referendum we mentioned at the beginning of this guide. The pound basically rallied into the event because everybody was positive on the pound and expecting the outcome to be positive too, but the actual result was very negative and changed the overall sentiment of the pound at the very same time. Now, this qualifies as a great and valid trading opportunity to trade out of a risk event. And so finally, we're going to look at how you can trade the news in a slightly less intense fashion. This means matching strong currencies with weak ones. Now, this will be useful if you are trading, let's say, as a part-time trader or around your main full-time job. And here's basically how it works. Every single day, information is released from many different sources. This information incrementally changes the market's expectations. Now, big unexpected shifts do not occur very often in the markets. Now, in the meantime, the best news trading tactic is to simply look for clear sentiment divergences amongst the major currencies. So, for example, one currency could be weakening after recent data consistently disappointed the markets to the downside. Meanwhile, another currency might be flying high after a hawkish central bank policy shift. Now, provided that nothing changes either outlook, trading those currencies against each other is the optimal trade. This sentiment is usually old, which is something to keep in mind, so everybody is already aware of the situation and the balance has mostly been priced in. So it's important to note that this style of news trading yields lower probability opportunities from the other two examples. This is mainly because the market isn't really moving on anything specific at that time. The trade is fundamentally based on the fact that the market won't allow the strong currency to depreciate against the weaker currency for too long. Very quickly, they will spot an opportunity and basically just buy it back. Now, this is what is meant when news journalists and analysts describe a currency pair as being supported. If the base currency is the weak one, the pair will be described as being under pressure. In fact, the entire opportunity itself is presented when a pair moves in the wrong direction for no apparent reason. Then traders are usually taking advantage of this tactic when they talk of buying the dips or selling the rallies. Now, to prepare for these trades, you simply need to identify the currencies with the strongest and ideally freshest sentiment at that time. Once you've paired the strongest and the weakest together, you can then wait for the price to move in the wrong direction, and these pullbacks are where the real opportunity in this example lies. So traders will very often use key support and resistance levels to guide them in their trade management. Sometimes the sentiment divergence will be very strong, and at other times the sentiment is fresh for only a particular trading session. In these cases, a pullback might not be required, and the price often moves directly from the market open. Now, these little trading strategies yield predictable moves that play out over and over again in every trading day. So just remember to always be tuned into what the market expectations are for every currency at that time. And always trade with the prevailing sentiment in mind as well. This is the real key to making money from trading economic calendar risk events in your Forex trading.